Welcome to the debate. Today we are not just looking at charts where we are staring down the barrel of a fundamental shift in how the global economy functions. Donald Trump has initiated a 10 to 15% global tariff increase, and the headlines are calling this volatility, but if you look at the plumbing of the market, the price action, the liquidity grabs, the bond yields, it looks a lot more like a systemic repricing. The dollar is sliding, gold is catching a bid, and the indices are flashing these warning signs that look, frankly, dangerously like the start of a deep correction.
It is certainly a chaotic moment, I'll manage that, and welcome everyone. But while I agree the tariff news is huge, 10 to 15% is no joke, I think we need to be very careful about confusing a knee-jerk panic with a structural collapse. We're seeing indices drop, sure, but we are also seeing GDP growth and inflation data that is actually, surprising. So the core question here is this the big crash, or is it just another buying opportunity for the bulls who have basically dominated the last decade? I'm firmly in the camp that the underlying structural bullishness of these assets is being widely underestimated right now.
That is the million-dollar question. And I am going to argue that this time, buying the dip is going to get your hand bitten off. I believe the combination of these tariff policies, the sticky reality of the economic data we just got, and the incredibly precise bearish technical patterns on the NASDAQ and S&P 500, they confirm a deeper corrective phase is underway. I'm not talking about a little pullback here. I am looking at targets as low as the Q4 2025 lows.
Wow, the Q4 2025 lows, that wipes out months of gains. I think there's a real danger here of, perma-bear bias. You see a red candle and screen crash, but the underlying asset, the U.S. stock market, is structurally bullish. It wants to go up. The inflation data we saw on Friday was actually below expectations. GDP is still growing. I am just not convinced that the stagflation narrative holds as much water as you think it does.
I think you're looking at the headline number on inflation and missing the forest for the trees. Let's strip this down. We have a 10 to 15% tariff hike. What does that actually do? It raises costs for everyone. It crushes margins. That is immediate instability. We're seeing the dollar fall, which we'll get to in a bit, and gold rise. That's a classic flight to safety. But the smoking gun for me, the real indicator, is the bond market's reaction to the data.
You mean the repricing of the interest rate cuts?
Exactly. Look at the probability shift. Just a few weeks ago, the market was pricing in a rate cut in June at roughly 70%. It was a done deal in everyone's mind. Following this data and the tariff shock, that probability has cratered down to 48%. It is literally a coin flip now.
48% isn't zero, though. It's essentially saying the market is at equilibrium. It's saying we don't know.
No, but it represents a massive withdrawal of certainty, and the market hates uncertainty. It is pricing in a scenario where the Fed cannot cut because inflation is sticky, thanks to the tariffs, yet the economy is slowing down. That is the textbook definition of stagflation, and if there is one thing equity markets hate more than high rates, it is stagflation. You can't value a company properly when growth is dying and costs are rising simultaneously. The market is waking up to the reality that rates might remain between 3.25 and 3.5% for much longer than anyone wanted.
Okay, let's push back on growth is dying. You are painting with a very broad, very dark brush here. GDP numbers show the economy is still growing. It isn't stagnant yet. And regarding inflation, you admitted the print was below expectations. If we look at alternative metrics like Truflation, which we both follow, which tracks real-time data, rather than the government's lagged numbers, they show a much cooler picture. They actively disagree with this narrative that inflation is spiraling out of control. We have 45 days until the next cycle of PCE, CPI, and PPI data. Calling for a stagflationary crash now seems premature.
Truflation is a great theoretical tool, and I love looking at it. But Jerome Powell doesn't set interest rates based on a website's dashboard. The Fed looks at the official prints, and the official prints are saying, we can't cut yet.
Fair point. The market reacts to the Fed, even if the Fed is lagging reality. But here is my counter. Betting against the U.S. indices for a sustained period has been the widowmaker trade for 10 years. You know this. The source material for our analysis even admits this explicitly. Indices are structurally bullish. What you are calling a reversal into a deep correction might just be a routine retest of a breakaway gap or a new week open gap.
Right, the NWOG, the difference between the Friday close and Sunday open.
Exactly. If price dips into that gap and holds, your entire bearish thesis could be invalidated in 48 hours. It happens all the time. The market dips, tests a gap, refuels, and rips higher. Shorting into that is incredibly dangerous.
I appreciate the structural optimism, really. It's comforting. But I prefer to trade the charts in front of me, not the historical bias of the last decade. Let's look at the NASDAQ specifically. The price action isn't just weak, it is engineered. We are seeing the market respect a bearish breaker and a fair value gap.
Okay, let's dig into that bearish breaker because we hear this term thrown around, but why does it matter psychologically here? You're basically talking about a supply zone created by trapped buyers who are praying to get their money back at break even, right?
Precisely. You have a failed support level that flips into a brick wall of resistance. The price makes a low, rallies to make a higher high, sucking in all the breakout traders, and then crashes down below that first low. Structure broken. When price rallies back up to that original breakdown point, those underwater buyers sell to get out. That creates massive selling pressure. And what did we see on the NASDAQ just recently? We saw a dynamic where the market contracted, then had a sharp move up above the highs of Wednesday and Thursday.
The Judas swing.
The Judas swing, the fake out. That move up wasn't bullish strength, it was a liquidity grab. The algorithm engineered a move to take out the stop losses of anyone shorting and to lure in breakout buyers. Once it grabbed that liquidity, it displaced lower immediately. And crucially, it remains trapped below the bearish fair value gap. It is a textbook manipulation pattern intended to fuel the move lower. My sell side target is the February lows, and if those break, we go straight to Q4 25.
I have to admit, the fake out above the Wednesday and Thursday highs was clean. It really does look like a trap. But I have to ask, have you considered the geopolitical noise as a variable here? We have rumors intensifying about a potential US attack on Iran. That kind of speculation drives intense short-term volatility. It complicates the technical picture rather than confirming it. If those rumors fade, the risk-off premium evaporates overnight and stocks could just rip higher.
I treat the rumors as a catalyst that aligns with the technicals, not the cause of them. The chart was already printing that bearish breaker before the Iran rumors heated up. The news simply provided the gas for the car that was already pointed downhill.
I come at it from a different angle. I think the market is highly resilient. Even with the tariff news, even with the rate cut probability dropping to 48%, the sky isn't falling. The situation is muddy, I'll grant you that, but it is not spiraling. Look at the S&P 500. The S&P is holding structure much better than the NASDAQ.
How so? It's showing the same fractal weakness.
But my argument is nuanced here. As long as the market is inside that bearish fair value gap you mentioned, yes, the bears have the ball. I am not denying the short-term pressure. But if the market reclaims that breakdown area, if we get a daily close above that gap, that high becomes a new protected high.
Meaning, if we close above it, shorting becomes suicide.
Exactly. At that point, shorting becomes effectively fighting gravity. If we reject here, sure, we target the lows. But if we reclaim, we go higher. You are betting heavily on the rejection holding. I'm saying wait for the confirmation.
I am betting on the rejection because the pattern is fractal. It is happening everywhere. Look at the Dow Jones and the Russell 2000. They show the exact same pattern. Consolidation, manipulation up to take out stops, and now the expansion down. For the Russell, the sell-side target is explicitly around 2444. When you see the Dow, the Russell, and the NASDAQ all painting the exact same picture, it increases the probability significantly. This isn't just one tech sector having a bad day.
Correlation does increase probability, I agree. If the Russell is confirming the NASDAQ, that is heavy. But let's look at the currency underlying all of this, the US dollar. You mentioned earlier the dollar is dropping. Usually, a dropping dollar is good for equities. It makes exports cheaper. But here, everything is dropping together. Why?
Because the dollar is signaling a reversal, but not the kind that helps stocks right now. The dollar is forming a turtle soup pattern.
Turtle soup. I always love the terminology in this space.
It's a great name, but it's a serious concept. It refers to a specific type of false breakout. Essentially, the dollar took out the December high during January. It broke a structural high. Breakout traders, trend followers, they see that and say, buy, we're going to new highs. But the market didn't follow through. It grabbed that liquidity above the old high and reversed back down.
So the turtles are the trend-following traders who got trapped?
Exactly. They are the soup. The dollar entered what we call a premium zone, specifically an optimal trade entry, or OTE, between the 62% and 79% Fibonacci retracement levels. This false breakout signals that the liquidity grab is done and the true direction is lower. I am looking for the dollar to target the 2025 lows.
And usually I'd say, great, weak dollar equals strong stocks. But here, the dollar is weak because of the tariff instability.
Correct. It is a bad weak dollar. It's driven by fears of currency debasement and trade wars, which hurts the multinational companies in the indices.
That is a compelling argument. But I have to play the lawyer here and look at the invalidation level. The turtle soup is just a theory until confirmed. There is a weekly fair value gap on the dollar chart.
That is the line in the sand.
Right. If the dollar breaks through that weekly FEG, your bearish bias is wrong. The dollar would likely proceed to take out the January highs.
I agree entirely. If we blow through that gap, the reversal failed.
And we have to look at the euro to USD pair, which is simply the inverse of the dollar. The euro is currently at a potential top. The analysis discusses the euro potentially revisiting the top of 2026. If the euro is topping, the dollar is bottoming. If the dollar bottoms and rallies, that puts even more pressure on your bearish indices thesis. A strong dollar tightens financial conditions.
Which means heads, the bears win on tariff instability. Tails, the bears win because a strong dollar tightens rates. But currently, the structure heavily favors the downside on the dollar. And this weakness feeds directly into the only asset that seems to be truly enjoying this environment: gold.
Gold has definitely been the standout performer. It is the only green on the screen most days.
Absolutely. Gold is in a prime position right now. You have a falling dollar, based on my turtle soup analysis, plus the rumors of the US-Iran conflict. It is the absolute perfect storm for gold appreciation. Technically, gold took out a weekly low recently, grabbed that sell-side liquidity, and reacted strongly upward. That impulse is undeniably bullish.
The impulse is bullish, yes, but I question the sustainability if it's built purely on war rumors.
It is not just rumors, it is technical structure. Gold needs to hold the discount zone of that recent impulse. As long as it stays above that discount zone, the path of least resistance is up.
But there's a massive resistance zone sitting right overhead. We are looking at the 5266 to 5310 point range. That is a brick wall for price. You can't just wish that away.
Resistance is there to be broken.
Or to be respected. My skepticism here comes back to the breaker formation. Unless the geopolitical conflict actually expands, which we obviously hope it doesn't, a true trend shift to send gold parabolic is unlikely. If price fails to hold that discount zone you mentioned, the bullish structure collapses immediately. We would just be looking at a range-bound market, chopping everyone up.
I see why you think that, but the market hates uncertainty. Tariffs are uncertainty. War rumors are uncertainty. Stagflation is uncertainty. Gold thrives on that. The fact that gold grabbed the weekly low and immediately displaced higher tells me smart money is positioning for a breakout, not a range. They are hedging against the chaos Trump just unleashed.
Let's circle back to the indices for a moment, because that is where most of our listeners are heavily focused. You are calling for a move to Q4 2025 lows. That is a massive correction. What would it take for you right now to abandon that view?
It's simple. Price would need to invalidate the bearish breaker on the NASDAQ. We would need to see a daily or weekly close above the bearish fair value gap that we are currently sitting in. If we reclaim that level, then the manipulation was actually a true breakout. But as long as we are below that gap, and as long as we are respecting these bearish arrays, I have to trust the tape. The fake out above Wednesday and Thursday's highs was too clean, too precise. It screams trap.
And for me, that is exactly where I urge caution. I acknowledge the bear signal. It's there. We can all see it. But we are also dealing with a breakaway gap. Sometimes the market dips into these gaps not to reverse, but to refuel. the GDP growth, and the fact that inflation, while sticky, isn't exploding, suggests the fundamental floor might be much higher than you think. Shorting the indices is often referred to as picking up pennies in front of a steamroller for a reason.
And sometimes the steamroller runs you over if you stand still. The tariff hike is a fundamental change in the rules of the game. It is a tax on the global economy. That justifies a severe repricing.
A repricing, perhaps, but a crash to 2025 lows, that implies a recessionary environment that the data just doesn't support yet.
The market is forward-looking. It is pricing in what comes next, not what happened last quarter. And what comes next looks remarkably like stagflation.
We shall see. We are coming to the end of our time, so let's summarize our positions.
From my perspective, the evidence is heavily stacking up on the bearish side. We have the macro headwind of 10 to 15% tariffs. We have inflation data that has killed the certainty of a June rate cut, dropping odds to a mere coin flip. And most importantly, we have precise price action. The Nasdaq and S&P 500 staged a fake-out above weekly highs, grabbed liquidity, and are now respecting bearish gaps. My roadmap points to a run on the sell-side liquidity at the February lows and potentially extending down to the Q4 2025 lows. The dollar's turtle soup reversal supports this broad risk-off environment.
And I come at it with a healthy dose of skepticism. While the short-term signals are flashing red, I believe the structural bullishness of the U.S. indices cannot be discounted. The economic data is ambiguous. GDP is still growing. I believe this drop could simply be a retest of the breakaway gap or new week open gap. If those hold, the bears will be trapped. I am watching the weekly fair value gap on the dollar closely. If that holds, the bearish thesis falls apart.
It really does come down to those key levels. Can the indices reclaim their bearish fair value gaps, or will they reject and drop?
And keep an eye on that dollar weekly FBG. That is the linchpin for the broader market direction.
Absolutely. The charts never lie, but the interpretation is where the battle is won or lost.
Indeed, there is a lot more to explore here, so check your own charts, find those breaker and gap levels, and form your own conclusions.
Thanks for listening. We'll see you next time on The Debate.